Gold's at
Sure.
4,000 bucks, okay? Made a low in 2015, we're 1,050. So we're fourfold, okay? If you go back and look at the two prior bull markets, 76 bear low to 1980 high, 2001 to 2011, both were eightfold moves, bear low to bull high. That would be a norm. I'm not saying you're going to stop there. I'm just saying when you get to 8,000, at least you have matched the peak at 1920 in 2011 and the peak at 850 in 1980, which were the end of eightfold dimension moves over different spans of time, but same dimension on a ratio scale. Match that, you got to go to 8,500 or something.
Momentum analyst Michaeloliver explains why the current gold cycle is still unfolding in a structurally powerful way. He notes that since the 2015 bear market low near $1,050, gold has already delivered a fourfold increase to $4,000, yet this advance remains modest compared with the two major bull markets of the modern era. Both the 1976 and 1980 surge and the 2001 and 2011 expansion produced eightfold moves from trough to peak, despite their different time spans. Oliver argues that if gold matches the historical norm of those ratio scale advances, the market would naturally gravitate toward the $8,000 to $8,500 region. It wouldn't imply a final top, only that gold has equaled its prior secular thrusts. In his view, symmetry matters, especially in a macro environment where confidence in currencies continues to erode and momentum structures favor higher highs ahead. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
This first one is the gold versus S&P 500 spread chart, meaning the relative performance action of gold measured against the S&P. And what we do here is we simply take the closing price each month of the front month active gold contract. Right now, that's December gold, and divide it into the price of the S&P, express that as a percent. Right now, as of last Friday's close, it was at 61.8%. Okay, dividing. Now, that's not the end of the month, though, because each of these are end of month except that last reading, which is not. That's intra-month. 3 trading days left after we do this interview. Back in 2011, we all know gold peaked in price and dropped hard. And during that process, it really started to collapse in the year 2013 and dropped to a final price low. And again, not this chart. This is a spread chart. Gold made its price low in December of 2015. And that's when that spread dropped down first time to near 50%. Okay, you can see there, December 2015. But it had already come down hard. Okay, they had a nice rally after that bear low in gold. In fact, we turned bullish on gold at that point. Gold was 1,050 at that low. We turned bullish at 1140. But anyway, at that point, gold rallied sharply, but also rallied versus the S&P, and therefore you see that shot up to the green line from that low just above 50. He shot up just below 65, okay, in that first surge, okay. But actually, there'd been a high prior to that on the spread that shows up as well. But anyway, you came down again in performance. Gold underperformed the stock market down to a low in 2018. Rallied again hard in price and against the S&P and shot up there just above 60% in 2020. We all recall the 2020 surge in gold because it had increased 40% in price from early 2020 to mid 2020. Gold went from like 1,400 over 2,000 or something. Anyway, and the spread also rallied, okay? Then it failed again there, found resistance, sold off again relative to the S&P and also in net price. Gold pulled back then and made a low under the 40% level, okay? And then you based for a couple years. And that was that period of time, if you recall, on gold net price chart, where it went sideways. It kept going up to 2,000 and get bashed. Its low was like 16, 13 in that couple year period, so about a 20% pullback at extreme. But it went sideways, and the spread went sideways as well from 2021, 22, 23, 24. In March of 24, we put out a report arguing gold's about to wake up out of its 3+ year doldrums. And sure enough, the spread also exploded. And where did it go? It went up to the line in April where it hit the green line again. Now that green line is very important because it's recurring too many times as a pivotal point of resistance. 4 times you've hit that line, counting last April's high, which was just below 60%. And after the April high in gold, that's when gold reached 3,500, by the way. Gold pulled back for 4 or 5 months and went sideways, net price, a 5-month range, and the performance pullback. So you get the pullback from that line of resistance. You've now emerged above an 11-year base top, clearly defined by 4 pivotal highs. Nobody's looking at this chart. They're all just looking at, oh, gold's 4,000 plus. That's a huge
Mhm.
move, which it isn't. I'll explain in a second. You close here, you got a breakout. Now, what does this mean? Well, if you'll notice, every time this thing rallied, the spread up to that green line, that was also gold rallying in price, okay? Including the recent move from 2024 to the present, gold exploded in price. And so did the spread. You're just now breaking out freshly over a massive decade plus structure. If this were a price chart, some little company that produces a product and it had a base like this, and you saw that breakout, any technician would say, I got to buy that guy. Okay. Well, what this spread chart is saying, there's about to become a massive shift in asset performance and preference into monetary metals and out of the S&P. This breakout signals that the arm wrestling match that we've seen for the last decade, up and down, really basically sideways, either side of 50%, okay, is saying, I've just broken out. This is something starting, not ending. So what I suspect is going to happen following this breakout, technical signal, is that more money flow can rush into the monetary metals, which it's already been doing, as evidenced by the breakout, and outflow coming from the stock market. This just begins it. So in effect, if you flip this chart upside down and did it the other way, divide the S&P into gold, you'd see a topping pattern breaking through a support line. So either way, it says big asset change out of stocks, out of the paper bubble, into monetary metals. This is the chart that I think is the most important one right now for any investor. Yeah. Oh, another comment on the gold. Gold's at 4,000 bucks. Okay. Made a low in 2015. We're 1,050. So we're fourfold. Okay. If you go back and look at the two prior bull markets, 76 bear low to 1980 high, 2001 to 2011, both were eightfold moves, bear low to bull high. So on a ratio scale, we're only halfway to what those two bull markets already did. And yet we've got conditions out there that are fuming and starting that could drive gold well past an eightfold move. This spread is saying, don't think gold is overvalued. It's just beginning. That would be a norm. I'm not saying you're going to stop there. I'm just saying when you get to 8,000, at least you have matched the peak at 1,920 in 2011 and the peak at 850 in 1980, which were the end of eightfold dimension moves over different spans of time, but same dimension on a ratio scale. Match that, you got to go to 8,500 or something, okay? And I don't put that out as a target. I just point that out as a fact that, oh, we've done it a third time. Big deal.
Yeah. Michaeloliver breaks down why the gold to S&P 500 spread is signaling a significant shift beneath the surface. By comparing monthly gold futures to the S&P 500, the spread has now broken decisively above an 11-year resistance band that capped every prior rally since 2013. Each time this level was approached, gold surged and then stalled, but this time the structure has been cleared, suggesting a long-term rotation out of equities and into monetary metals. Oliver reminds investors that gold's current fourfold rise from its 2015 low is only half the magnitude of previous eightfold secular bull markets. With macro conditions far more volatile today, the implication is that the move is just beginning, not ending. Let's get into the interview.
You take that, let's say we end up the year, we gain 10% on the S&P or so. Okay, fine. Okay. He'll still smile. But if you take that away in the first quarter of next year, he's got nothing to smile about. Therefore, emotion comes into play. And already we're seeing emotion out there because we're seeing partisan splits. Within the Democrat Party, there's a lot of emotion. Republican Party is splitting now, fracturing in ways that probably are not going to come back together. So you're seeing evidence of the consequences of this bubble burst even before it bursts. And you can bet that when it bursts, the pain will be very loud and will exhibit itself in ways outside the market even. And right now we have a debt problem that is at crisis level that is way beyond just mortgages. We're talking about central government debt, Japanese debt, UK debt, US debt. We've got a US T-bond market that acts like it's comatose. And even the president of the New York Fed, Williams, 2 weeks ago said in a talk, no doubt approved by higher ups, that we're going to start buying US bonds because of, quote, illiquidity. Yeah, bonds are supposed to be the 40% alternative to the stock market.
Right.
And yet when we got trashed, stock market, during that last week and even before that, off of the 7,000 high, we dropped down to 6,500 last week. It took several weeks. Bonds didn't recover. Bond prices laid there at high yields. Prices just wouldn't rally. yields wouldn't drop. They don't control the long end of the debt market, and now they're trying to, meaning they're concerned about something. I don't know what, because they all say everything's fine, but obviously they're concerned about something. I think you might even see evidence of it before the end of the year, but the triggers that I'm looking at, you're basically, one of them is already at a pull level where you've already pulled the trigger. All you got to do is close the month where you are right now, and that trigger gets pulled. We can look at that first if you want later. And then the other one, there's another trigger I'm looking at that is close. And when these triggers break, it's telling us something is about to begin, not that the monetary metals, which seem to be had an explosive move, which they really haven't. I can explain that too. It's just beginning. And it's not just a function of them going up, it's a function of another asset category going down. Because so far lately, you'll notice, except for January through April, when the stock market imploded 20%, gold shot up during that time. Total opposite to what the assumptions are. So did silver during that time. So you can look at both charts and sort of say, well, they're sort of all going up together, and they're really not when you measure them versus each other. And there's a signal structure that's about to be crossed that says that it just began. Something big just began. And it's at that point that my working assumption based on historical analysis is that in the 6 months following the trigger pulls that I'm going to show you, you'll see dramatic net price movements, especially in the monetary metals. Something that'll take your breath. Not normal.
Michaeloliver warns that emotional pressure is rising beneath the surface as equities hover near yearly gains that could vanish in a single quarter. Political fractures, mounting sovereign debt, and a dysfunctional bond market are all early symptoms of a bubble already straining before the break. Even the New York Fed has quietly signaled concern by acknowledging plans to step in and buy treasuries due to illiquidity, a sign that the long end of the market is no longer behaving normally. Oliver notes that several technical triggers are now inches from being activated, signals that historically precede sharp, directional moves. Once those thresholds are breached, he expects powerful rotations, monetary metals accelerating upward while significant risk assets begin a decisive unwind. According to Oliver, the next phase is not ending, it's starting. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.